My name is Zebra Khan, and today I'm going to teach you about sensitivity analysis and capital budgeting. Today we'll be discussing how financial management and risk analysis guide effective capital budgeting decisions. We'll start first by looking at the goal and functions of financial management, then move into how capital budgeting involves risk. Next, we'll cover sensitivity analysis, including both quantitative and qualitative steps. And finally, we'll explore internal and external financial methods for assessing risk and conclude with key takeaways to integrate these tools into practical decision making. By the end of the session, you should have a clear understanding of how to analyze project risk and make informed, value driven investment decisions. So we'll go ahead and start with the goal of financial management. The goal of financial management is to ensure that a business uses its financial resources efficiently and effectively. This means making sure that money is allocated to the right activities, investments, and projects that create value and progression for the organization. Financial management also involves managing budgeting and cash flow on day-to-day basis operations, as well as optimizing the company's capital structure. And by balancing debt and equity appropriately, the business can maintain profitability while supporting its long-term growth and sustainability. And finally, financial managers are responsible for identifying, assessing, and mitigating financial risks such as credit risk, market risk, and liquidity risk. Proper risk management helps protect the business from financial instability and supports informed capital budgeting decisions. Next, we'll go over risk and capital budgeting. So, companies use capital budgeting to evaluate major investments by estimating future cash flows and using tools such as NPV, net present value, and IRR, internal rate of return, to predict financial performance. These methods help determine whether a project is likely to add value to the business. And because capital budgeting focuses on long-term investments, many assumptions are involved. Nothing's really set in stone. So there's kind of some uncertainty there, and they can change over time. And this introduces risk into the decision-making process. Risks such as market and economic changes, declining customer demand, and fluctuations in operating costs can significantly impact results as well. And if these risks are not properly evaluated, they can pose serious financial threats to the company. Next, we'll go over the quantitative steps in sensitivity analysis. So sensitivity analysis focuses on changing only one variable at a time so we can clearly see its individual impact on the project's results. This helps isolate which assumptions are driving changes in performance. The next step is identifying the most important factors that cause these changes, such as sales, volume, pricing. These factors represent the greatest source of risk. We then measure how these changes affect the key financial indicators like NPV and IRR. And then finally, realistic scenarios are established to reflect conditions the business may actually face in the future, helping managers prepare for uncertainty. Next, we have the qualitative steps in sensitivity analysis. So we focus on the non-numerical factors with qualitative. And one key factor in changes is the technology, which can make equipment or processes obsolete more quickly than expected as technology is advancing. And then we have experience in management, social and environmental impact, and competition in the industry. So people are constantly learning new things, getting better, getting more management, and this all plays a role into sensitivity analysis. Next, we have the internal and external financial risks methods within the company. So, by reviewing historical data, businesses can identify patterns in costs, revenues, and cash flow performance from past projects. Break-even analysis is also used to determine how much output or sales are needed for a project to avoid losing, helping assess operational risk. External scenario analysis, going through different scenarios, and market and industry analysis, reviewing the market and what's out there. So, in summary, effective financial management supports long term success by guiding capital budgeting decisions. Because these investments involve uncertainty, sensitive analysis helps identify and manage risks using both qualitative and quantitative methods to leads to better, more informed financial decisions. Here's my references. Thank you for listening to this presentation.